to be back. It's been a while since I've done this, it feels like, so hopefully this goes well. While I was away, I was at the CMT Symposium in New York, as well as the NAME, National Association of Active Investment Managers Uncommon Knowledge Conference in Scottsdale. And the opinions are fairly positive out there of where this year is going to go. Now, I think everybody also thinks there's going to be a recession, and where that's going to hit is going to be next year. You know, we're looking at 6 months from now, maybe even longer, maybe 9 months, but something bad is out there eventually. And what's interesting, and the part that we've seen before, is the way that 2021 set up to have the bad 2022, if you recall. 2021 was fairly positive, but we had the same issues we're seeing today. We're seeing bad breadth. Market has bad breadth. So thinking of what's driving the stock market right now is only about 7 or 8 stocks, just like it was in 2021. And what happens then, it makes it look like things are okay when really they're not. When underneath, so many stocks are going down and not doing as well as what's perceived, because I think 7 or 8 stocks are now 30, 40% of the market cap that we see. So when we think things are going well, we might not be seeing that underneath something is not going right. And that's where we are right now. This was just yesterday. This is a equal weight versus capitalization weight of just tick by tick of the minutes. I know that's way too much data to throw at you, but think about it this way. This interesting is that we had a reversal day yesterday where this was the big names, the tech stocks that have been driving everything up. So NASDAQ was down a lot and everything else actually did well. Mostly small cap went up. I think that S&P was down a little bit, but this is a equal weight, showing an equal weight of small and large. And actually things weren't terrible, but if you look at just the big stuff that's been driving the market, it was ugly. Now, normally there's not this separation between positive and negative. It usually looks more like this. They're kind of in the vicinity of each other. They both kind of move in the same direction, but this was wild to see totally positive, totally negative divergence in the market. And what's interesting is really for the past month, it's been the opposite. We've really had only the tech stocks going up, the NASDAQ, the large growth, and really small's been getting killed. International's looking ugly again. And so across the board, and value is not doing well. So that's usually the safe stuff. The safe stuff has been just getting crushed. And I'll show you that later in our rotation chart. So bad breadth. And again, we've seen this before, and this has me a little bit concerned. It's because we're seeing market breadth go well, right? But we're not seeing it in the market action that we should be seeing it, right? This was all going sideways in May, but tech was going well. Where now we're seeing, oh, well, small cap is bringing it up, but everything else is doing bad. It feels like there's a little bit of a disconnect between what the data is and what the market's doing right now. And I'm very, very aware of that because that's what caused us. We saw issues with that in the first quarter of 2022. Then that was around when Russia was attacking overnight. We'd have crazy changes, but the data never really matched what was happening. And we're starting to see that kind of disconnect happen again. So I want to see where this goes, but I'm very cautious of what the breadth says right now because it's not matching where it should. Again, our advanced decline is looking well again, but that's really just everything that's been so beat up has just done a little bit, and it's making it look like things are better than they are. When you really dig down into these numbers. Here's where I'm talking about sectors versus positive, negative. Right now, we've got 8 positive sectors. We've got 3 negative sectors. Now, the 3 negatives are the consumer staples, utilities, and healthcare. These are normally consumer, discretionary, utilities, and healthcare. This group is the safety place, the places you go when things are safe, and they've just been getting killed. They've been having the worst time while tech has been doing okay. Technology over here is strong, but it's now getting a little bit long in its duration. We're looking at 20 days positive. As we've seen over the past couple of years, the cycle tends to be about 20, 25 days, and then it shifts. So we're just seeing now first 1, 2, 3 days positive over here. So we're going to pop to the positive side very soon. And then we'll see probably 20, 30 days of positiveness in the defensives. And that's not really good for the overall stock market if that happens. Because right now, consumer discretionary, that's like Amazon is doing well. Finally, after not in industrials, I'm not sure why that's there. Financials are peaking up. That's really more the small mid cap base. I think it's the more regional banks that are really having a good time right now and catching up, where they've just been just so far down. And XLC is the communications. That's like the Facebook, the Netflix, the big tech names like that. So it's communication really is what you think of as tech, but it's not. And then real estate's finally catching up, but it's having a rough time. So it's only been positive 4 days. Same with materials and energy. They've been struggling too. So it's just an interesting, I think, bifurcation of the market where some things are doing well and some things are doing bad. And really, when the market's healthy, it all moves together at the same time. Up, moves together down. right? Here's those three: the communications and technology, consumer discretionary. These have all been up in the leading box, while all these guys really have spent the last month down in this area, lagging the T-bills. So it's not being, it's lagging safe money. So it's really a place you don't want to be, but they're all pushing up into the positive now. But what I don't like is these guys are all pushing down into the weakening box, and they're not really working together. I really want to see these all sitting in the same box and they kind of move together as they have been. And then there's more of a trend that we can jump on and ride the waves up and down, but it's not really doing that right now. It's very separated. And then we've got the ratio between the S&P and the NASDAQ. And this has been really, really key in the last couple of years. So last year, S&P was doing better than technology. And I'm not really sure why technology had such a bad time, but it did. It got wrecked. So what was happening here is this means the S&P is outperforming the NASDAQ. So you want to lean that way and get out of tech. But since really January 1, it's been up. So even with these little bouts of sideways, not sure, sideways to down, each of these have been great pushes up, where the NASDAQ and technology specifically, the Apples, the Netflix, the Googles and Metas exactly, are pushing this up. That's really all that's going up. And that's why we're seeing this kind of a separation. What's really interesting is back here, this little spot is where banks were having a bad time. So owning tech and not owning banks was just easy. I mean, it way outperformed by just being on that side. Even though things were going down, the tech just went sideways. If you can kind of see it, the purple sideways where the blue got hit pretty hard. So that's what this ratio is showing. And then seasonally, June's not a great month. This is the S&P since 1950, so it's 73 years we're looking at, 72 of history, where June is really not a great month. May was up for the S&P, but barely. It was really, really kind of a underwhelming month. Now in June, if you look at the NASDAQ, you look at the large cap growth, a lot of the growth side, small cap growth, these are all negatives for June. So I don't have a real positive view of June. And not that I think it's going to be a bad month, just I think not much is going to happen. We really need to see some sort of shift in positivity. I want to see more of the broad stock market be positive and really push up. But coming into July is historically very good before we go into the ugly fall season. So we've got something to look forward to where I think is going to be pretty positive, but we've got to get through June 1st to really think about that.